Mr. Ben, he's back. Hi, anyone there? Got a bit carried away with non-farm payrolls there, lost track of time, sorry. Sort of sits with how we described earlier, very confusing, lots of weird parts. That is a weak number, lots of revisions. Last month's nonsense that we talked about and explained on the non-seasonally averaged under the hood was weaker. That's what we thought from Jolts as well. Looking through it, it was going to be, there was positivities in some of the areas, but not as much as was estimated with the seasonal adjustment. That's unwound. And we talked this morning on the chat about where the areas were that could come under pressure. The people don't talk enough about it being private and government. And so it proved private was poor, only 132,000, a lot of service industries disappearing. So we're worried about service strength, service inflation is sticky. That's the thing that's stopping the rate cuts. Is this finally the piece of data that might stop that? Within it, 70,000 of government jobs. But where it comes for you to be able to analyze it is the revisions. Like I said, April was revised down. And then last month, the 272 was revised down by 54,000 to 216. Is that right? Yeah, 218, sorry. So the headline miss, which caused the little knee jerks by the algos or the idiots that just hit the screen straight away, flicked the dollar up, sent gold down. So the 191 estimate came in at 206. But net, that's plus 15, take away 54. It's a net 39 miss on the print, etc., etc. So we'll go through some of that, and we'll have a quick look at the data before we talk about other things. Kaizen, thank you. Yeah, I hate this because you have to unmute 3 or 4 things. Yeah, excellent. We'll start again. Basically, that's the miss. A lot of people, we talked about this morning, to stay ahead of it using a lot of visions, etc., etc. So it shows there's no if you've got mic problems, you have to put your Rob Stoll, because we're going to have the add mute the problem. So the revision for last month's ridiculous print of 272 that we talked about during the week is coming in financials and services and professional services. It was estimated up in the last print when we had 80,000 up last month on non-farm payrolls. I'd showed that they didn't actually move at all. Jolts showed that there was some movement, but not as much as the non-farm payrolls of last month expected. And Jolts, if you didn't read the chat this week, is for the month previous. That's why it always comes out a month late, so it's not quite current. That's a lagging indicator, but it fills in the gaps. It's done by the same people that do non-farm payrolls. So down 54 on the revision for May, up 15 versus consensus this month. That's actually a 39,000 miss. So for those that are confused, that's why there was probably knee-jerk movements straight away. But the real thing here is it's just another, in aggregate, another negative print in the mix. Within it, I told you should be looking at the household report. So the non-farm payroll side is the establishment, this the household. The unemployment rate went up to 4.1%. That is due to the labour force going up, the thing you have on the bottom, the dividing thing, as well as a load of immigration disappearing, supposedly. We'll have a look at the whole report in a minute. So there's pressure coming there because 4.2 is panic time. 4.4 is something that I've heard about called the SARM rule, which is an economist that came up with the fact that would mean there'd be a 0.5% deterioration on a 3-month average basis. Then the Fed would be worried because that always leads to a recession. So it's moving in the right direction, but not as bad as that. But in the employment side of things on the household was only 116,000, I think, versus the 206. That is on, 116 versus the 206 that has just come out on the establishment side. And we've been saying, which one do we actually rely on at the moment? It's the household that seems to be more accurate. Is a rumor, and it seems to be playing out, that the non-farm payroll side is about 60,000 wrong on average, and it's going to get corrected at some point. Well, a lot of these revisions that are coming through are sort of doing that as we go along. Other things that I want to talk about today. Just the data versus politics in general for how this week has gone. We've seen that Labour have won. Any clues from that? We're going to go through non-farm payrolls, the dollar setup. The Casino Royale event tomorrow. Be interested to know if anybody is actually on here that's going to that. If you've got anything that you definitely want us to discuss ahead of things. Just pop out the chat so I can see you. And is there anything in general that you've been struggling with this week, don't understand, want to talk about? Please fire away on the chat. Right, let's have a look. Let's go to the data. So, as always, it's best to go and check the numbers yourself. So, if you go to the bls.gov and go into the news releases, you'll see the employment one. And you can see what I'm talking about is that there's a household, table A is household and table B is establishment. So the one that you see all the big headlines on is the establishment one, the non-farm payroll. And there will be an overall chat. The good thing to have is the data to hand, which you see on the calendars, which tells you, always know what the figures are before you go into it. And then you'll be able to see how those changed. So that's showing you 218 for May. If you just went in blind, you wouldn't know, but that was the one that was 272,000. We were talking this morning about private and whether ADP actually predicts it or not. Thank you, Chris. We'll have a look at that. NASDAQ and the Dow, they're both in a different situation at the moment, and it's the makeup of the indices that is the problem. We'll talk about that later. Thank you for the question. So yeah, on here we're working through. So 136 was a pullback, and just by definition, looking at those, you know that 206 minus 136 gives you 70, which is going to be the government, which is down here at the bottom of the page. As you scroll through, so it's private plus government gives you total non-farm payrolls. And as I flippantly said earlier, it's a problem. If government is bigger than private, then you know you've got a problem. You're going to be in close to recession, really. So it's not good that they're moving towards each other. And then you can see the sort of area, any blips, any particular areas. So retail struggling month on month. So that professional business service is the one that causes all the angst this week. But temporary jobs, they dropped 50,000. So there was chatter that it was all to do with a lot of temporary help in education and health last month, and then that's actually come back in this month's survey. So that is interesting as well. We had the jump in hospital and leisure that came through in JOLTS, and that's fallen back a little bit. So next month's JOLTS should see the continuing downtrend of the opportunities, probably by the sound of reading through all that. So like I say, this is the one that keeps getting revisions, which is what's making people not trust it that much, and it is causing us issues because everyone follows the headlines. So let's go and see what the household says. So yeah, you can see here, you get some funnies in the US. I mentioned it with initial claims, the civilian labour force, in order to be available for the labour force over there, you have to sign on. So often that can make the denominator go up. But if the denominator's gone up, then that tells you that the number unemployed must have gone up as well. And it has. Look, it's jumped by 260 odd. 160 odd, isn't it? 162. So the net effect of that is a 0.1 increase. Participation. So yeah, so your labour goes up and participation goes up. That means some people signed on to take jobs. Then you get all this other data. People not around. What age groups are getting employed, etc. And then this starts getting interesting, and you get that in jolts. It's the reasons for not being employed. It's either we know that temporary has increased. We've seen that. Job leavers, that's people normally who go to have another job or just don't want to work anymore. And there you go, look. So that those people that have come back into the labour force, so it's re-entrants and new entrants, 120 odd thousand, that makes sense to what we've seen up there. So this starts to get interest. This is where people should be looking. So you get the reasons for people taking part-time work, and it's for economic reasons. Often you need to have more than one job. And then slackened business conditions. So people are employing people for less. That means things are slowing down a little bit. Actually, so that is what those mean, but actually they've gone the other way. So that's interesting. So you can only find part-time work, but a lot of it is around the edge. So things, yeah, so that might cause a little bit of pushback from a few people just saying that the part-time setup is a mix. It's dangerous how many people are in part-time when it's above 4 million. Is always a problem relative to there's normally a figure for how many are employed. Yeah, so at least a quarter of the workforce is in part-time. That's always an issue. But that actually might be an area I'll have to have a look at that later, why that is happening. That might just be that there's no job opportunities at all, which would be worse. Anyway, the net of the thing is that the household report is going the wrong way relative to the non-farm payroll side of things, which is why we should be getting the reaction that we are. We'll make the next meeting quite interesting because, as I said, Goolsbee is being sent out to bat for the Fed at the moment, and Williams himself has kicked back on the people who are relying on natural rate of interest rates being higher. He said there's no reason why that is empirically, and we won't be using it for policy. So the people on the edge, who happen to be the hawks at the moment, they don't have the voting majority. Their reasons are gradually being talked away by the talking heads. That's actually a change of narrative over the week, which you may or may not have noticed. That normally like a couple of weeks ago, they've all been saying in a similar vein, need more data. People have actually started to concentrate on the exact pushback. So this whole thing is just moving towards making it palatable to take a rate cut. It's a slight change in the whole narrative, in my opinion. So keep an eye on that. Are any of the people who are normally on here having problems with the sound? Cool. Yeah, so any new joiners, I think you just have to sort out your own end. It's something to do with my Riverside going into YouTube, and you need you need things at your end to adjust. So hopefully that sort of explains a lot of what's going on in the non-farm payroll. The trends are going the wrong way. I'll do some more work on that afterwards and look at that part-time thing, but that is only a small element of it. So dollar-wise, we'll have a look at that one. And as I said, is anybody that's actually watching today coming to tomorrow's event in London? In which case, I'd love to meet you if you do come along, introduce yourself. There will be a load of giveaways amongst that, as well as some great speakers. Shame, Julie, I know you're busy. Also, we've got earnings seasons properly starts next week. So anyone that follows indices, we're going into what is quite a headwind. By that, I mean it's quite challenging to beat what the expectation is. We had a great Q1 in the US. Europe wasn't too bad, but in the US, we're expecting 9% average earnings increase. So they're going to have to come in double digits, and with a continuing good outlook for the rest of the year to actually make gains. So we may just be close to having a few headline moves, a little bit of rate support, continued breakout, but then we're going to have to potentially have a little bit of consolidation through earnings season. Potentially, all depends on the timing of the Mag 7, particularly, and that is for like the S&P and the Nasdaq. Within the Dow, the Dow is a price-dependent index, so it's a weird setup, and it only has three the big tech stocks, doesn't it now? Apple, Amazon, and something else. But it hasn't got Nvidia, which has been the big new one. I don't think it has Alphabet or Meta. So net, it's not a real reflection, particularly a lot of big name stocks. Anybody that does a stock split, etc., gets removed because that has a big impact on the Dow. So it's a bit of a manufactured index these days. It only really has the name which attracts it. You need to really follow what's going on in SPX and Nasdaq for trends, but obviously the Dow does trade, and it does have reasonable correlation with certainly the Elliott wave that I look at, and it's obviously a well traded index, but it is set up, whereas the others are market cap biased. So, which is why we're having issues. So when we've got three of the Mag 5 are 3 trillion, and the other two are 2 trillion. And then you've got Tesla doing catch up from 600 billion and has bottomed out this week. And Meta is 1.2 trillion. That Mag 7 are huge relative to a lot of the rest of the market, which is why I've said if we do see more breadth, the market might not actually move on that much, because the heavyweights will be going sideways, if not down, versus inflows into the others. So it might mask the fact that the underlying index is strong, and we're seeing good momentum when that happens, but the price level may come back short term. So we're in that 3, 4, 5 things. We're towards the top of some 5s and 3s. So we've got consolidation ahead of us. It's just literally putting in the tops of the breakouts now. Next week is CPI in the States. Look out for the rent element of that. We've started to see, as we've pointed out, the insurance side of things, the airline side, the healthcare, they're all going sideways, if not down. The ascent has stopped. In fact, the healthcare costs in aggregate kept PCE from being negative, which is the thing that the Fed follows. So we're very close to having, just like we've had all things going in the wrong direction, I think we're very close to everything going in the negative direction, in which case it'll be talking head, quivering lips, panic. We're behind the curve. What we're going to do, and the fact that rents haven't moved, that we're waiting for that. There's a lagged effect. They are going to fall at some point, and it will be because it's a heavyweight in CPI. So over a third of the index is rents. When that comes, it's going to have a massive negative month-on-month effect. So that is when it'll be breakout rally time. So again, we said we're looking for a short-term top. Once we get to a stage that they need to cut rates, then people start thinking that you've got a two-way pull. So is growth going to be enough? Will rate cuts hold it up? Is growth slowing too much versus rate support? And that's when you start getting a two-way pull in the market. So it could be that classic of buy the rumor, sell the fact. Once you get that negative CPI coming into data, we'll possibly have a little breakout on the rate euphoria, and then people will start analyzing it a little bit just to say, are the Fed behind the curve? And then we'll need to see what the net of that is before we push on again. We are in the positive period for the S&P in presidential years. We're in the positive 2 weeks for the year, which is the first 2 weeks of July, and it has been the best 2 weeks since March, I believe, or the best first week since March. So everything is adding up. It's just a case of how far does that go before we have a little consolidation. What I want to talk about there with Labour and Liberal Green Reform, anyone missing? So Labour have got the big majority, 170 odd, is it, whatever. The Liberals have jumped up to 70 seats. They seem to be the main beneficiaries. The Green percentage has gone up, even though they've only got a few seats, and the same for Reform. So there is obviously a demonstration that there's more than a two-way party effect here, and that people will have to start listening to the pressure groups. The Labour Party will be pressured now by the Liberals to do the European side of things, which I said on the chat earlier, they need to resist. It's not the right time to go back in. We'll be on the back foot. But the way things in Europe are going, then it might be a little more favourable time down the line if you need to get back involved at any kind of official level. So I think Labour will probably try and shut down that debate because it'll be a sidetrack to getting their agenda done. So we'll have some noisy Liberals around, and then we'll have obviously Nigel Farage in there having finally won a seat. So it might make it a bit more interesting, but whether anything of it actually gets done will be another thing. But the markets were happy. Sterling was happy because Labour by themselves haven't got the blowout majority. People might start to think, be interested to see what the strategists say over the weekend, the whole dynamic of Liberal and the Labour left on the European angle, etc., whether that could cause any sterling issues. So a lot of new, sort of newish names that I'm seeing that are all saying about the volume, which shouldn't be a problem. I've got the people that normally have it on say it's all right. I'm told that you have to mess around with things at your end. So it's normally okay on all the recordings that I do here on the same Riverside through you. Only imagine it's something in your setup. And the first one of those, we're going in reverse order, the data versus politics. So got the whole Biden-Trump performance done previously. He's never a great starter to the debates. He's got everyone excited about Trump, and that caused a yield shift. So the data for the first half of the week continued being, as we thought, negative bias. But we weren't really getting the responses from the bond market, and that was really repricing on the fact the whole Trump agenda with the inflationary outlook, etc., versus the actual near-term situation. And I think we're now probably beginning to reprice that back in post. The analysis of NFP should be, as I said, taken on the dovish side. People will work their way through the data as we've explained it. Net, that is bond positive. In fact, we should have the bonds. So this is where politics is an unfortunate sideshow at times. It gets the headlines, and then if the wrong headlines come out, then it's trouble at mill. So I always prefer to see them in the background. Politicians aren't necessarily great, but so that is the US 10-year, which for anyone that was following it, we were timing it into up the channel, but we've since gone into a consolidation. But now we're having a little breakout. This could be the start of the move up again, repricing in rate cuts, and potentially, if Biden is pushed aside by the Democrats, then there'll be a rally in the US Treasuries alongside that. So we could certainly go back into the next stage of the up channel. Just keep an eye on that. But certainly the data is suggesting it's very bond friendly. That gives yield support, lower yields. You divide all your future cash flows by a lower number. It makes them bigger, which is why you get support when you get data friendly, bond friendly, market yield friendly data. That's why valuations go up. You're dividing by a potential smaller number. So any questions so far on anything that I've said? And that's the end of a very dull week, but it's probably more exciting being out there in the markets today. So I'll just run through. I need to probably update as we go along some of my charts, so we'll have a little look. So gold and silver are going to be interesting, aren't they? Because particularly silver, if we're having a breakout, because that is in a geared position and it's got its long-term cup and handle breakout, which if we can get into the mid-30s, I think it goes a long way. But gold, which we can see here, we've had a number of setups. We've now got higher highs for the move. Something like data that almost pretty much confirms that we are in the uptrend, which probably are in the start of the fifth leg up. And within that, that means that June the 7th was the low that we've been talking about over here for the wave 4. You never got the lower low, the order block, and orders down here at that low sub it are supposed to be physical orders. Physical for gold. Again, anyone that's not been with us recently, that is all about the 85% settlement situation for central banks. They are the main buyer if they want to have it as their reserve currency, which it has that status now. You have to have 85% of it. So anyone that is trading short physical has got the market against them. And it's the paper selling, the market that we look at, that is in the wrong side of that. Only 4% normally goes to physical of all the trades that are done, but a lot of the open interest is halved. So there's fewer people actually playing that game. So that means that a bigger proportion of them are short physical if they're trying to get those people out of the way. And at some point they have to go and find it. They've got around it by leasing, which is getting ever more difficult. So they've been borrowing the gold to give to the buyers. Eventually they're going to have to buy it back. If the data's now changing as well, we've got dollar weakness. That obviously helps for gold breaking out. It's all about real interest rates, and that data is suggesting that real interest rates are going to come down soon. So we should be in the breakout. So for me, we've had the 1, 2, none of these put in a new lower low. They've all held on, some deep retracements, but most of the pullbacks have been 3 swings, which is what a consolidation pattern normally looks like. Even though they've not been mega impulsive, the moves up look better as sets of 5 waves, and it looks like we've got 5 swings of them at the moment. So we're not far off being at a near high. We're not a million miles away from having put 5 in. So we'd expect some form of consolidation and retracement of that, but it will be shallow now. I think we'll move away from those deep ones unless something material changes. But the primary setup for now is going to be that we're consolidating in what is going to be the third of a third wave in this fifth wave, and it should do most of the work in the next few sub waves up to take us to all-time highs and beyond. So this could be quite a swift move if we are in the right place. This moves, it's going to go quickly up to 2,500 probably, if not beyond. So just be careful with these shorts. This is the important thing. We've gone above the retracement line. It's a higher high for significant part of the move. I mean, there's still a potential that is an extending consolidation before it goes again, but we've been trying that. The fundamentals are changing. Fundamentally, you don't normally take on a higher low trend. That is the trend. So we'll have that as an aggressive primary for now, just because the underlying mechanics are saying the right things. So that non-farm payroll has kind of cemented that for us. In fact, the way that has moved around, having a deep little tick down on the headline, there's even an argument that we'd put in the fifth. We've had a retracement and we're now moving again. So this could already be 1, 2, and we're in the third wave. So again, I'm saying be very careful fighting it, because that is, in my parlance, third of a third of a third. Is getting towards pretty aggressive expected behavior. So I know you've all got your own ways of looking at it. There's lots of ways of entering, but be very, very careful now. The other way of looking at that is the dollar. I don't think I sent my charts this morning, did I? So we've been looking for a number of weeks to get in this fifth wave, which was a final C wave of another part of the nest. So nesting is 1s and 2s. The dollar has continually been putting in lows, retracing, lows, retracing, lows, retracing in a tight nest, of which we finally seem to be putting in some breakout. So we put in the fifth wave with another higher high. Since then, we've been working our way down. Another set of short-term 5 waves, a 3-wave consolidation, and then a 3, 4. And I was looking today for the fifth to potentially stop, and then we might get some form of dollar retracement before we go again. Now, the nature of it is tough. Looks like we've potentially put in the little low around non-farm, and we're retracing. So this retracement could just stall a little bit of the noise. It doesn't have to be as deep as what I said here. It can be anything in terms of retracement. And if we're about to go into third waves on a lot of things, expect that to be a very tiny retracement before we crack on. But we are potentially in short term, and until the markets find their way for the rest of the day, we could have a slightly deeper little play around in the dollar before it resumes the downside. So I think it's very important short term to watch the dollar at the moment. It's not always the positive correlation for risk assets, but given the way the data's playing, we're probably in a period where it is. Can you see that on? So GU cable, we talked about it this morning. This area over here has just wicked through it. It's building. I thought we're kind of close to a 1 high, and just like the others, there's potential for this. Sterling weakness, dollar strength to play out, but at the moment, obviously, the dollar is helping push it. But we have got a valid situation for to be in, but it could easily extend. I think we're in a bullish setup. We're putting in higher highs for this breakout of 5 waves here. So it's due a consolidation soon, but eventually we're going to take out this 1 high over here. We're dealing with these sticky resistance areas here, the fair value gaps and potential order blocks. But my primary, again, is that we're in an uptrend short term for GU. EU is the same. We'll see what happens over the weekend as to whether there's anything that gets in the way for Europe. But, you know, short term, keep an eye on the dollar. We're looking for potentially a three-wave pullback that we really want to own for sterling, because it's done enough short term to have had that move. We want to be catching the next one, which is the more powerful momentum. We've looked at the 10-year. Boom, boom, boom. So at least the pictures are showing up today. That's good. So UJ, again, be interesting to see whether they take advantage. So every time there's been a collection of good negative dollar data, they've tried to back that up because they get more bang for the buck. If there's natural sellers away from them, it helps. And we talked during the week, we were looking for high within this channel. Was that going to stop? Looks like we've probably put in that 3 top for now. It's got valid 5 waves in. And then we said we were looking for a consolidation. That has come out of the channel. So it'll be a new channel once we go back into the 5th wave, which is part of this overall blue channel anyway. That is the channel for the blue waves. So I'll be expecting to draw in a vertical channel from wherever this finishes. At the moment, that looks like a double extension. Let's just have a look. So yeah, we're not far off. But in fact, I might prefer to move that. No, that's fair, because that's had a lower low. Right, so we rallied back there. 1, 2, 3. So we're looking for 5 waves amongst this, of which we've got the valid 5 waves for a C wave. So that's potentially somewhere we're looking originally to see how it reacts around this equal legs area. So that could be a valid pullback already. So unless the Japanese are really coming in short term, that might have chance to go. I think we've got one more move up into that. So when do we have the Bank of Japan? The Bank of Japan is at the end of this month for their meeting, where they're only really said that they're going to move their bond buying to almost zero. Their leading indicator missed again today. So the underlying data, Tokyo CPI is good, gives them a chance to potentially move rates, but they're trying to avoid it. So there's a valid stopping point here. I would, if you want to play a buy on UJ, I'd have the 1-for-1 as a stop loss. This could develop into a deeper, bigger three wave move to finally get down into this zone, but it's done everything it needs to for the first valid purchase, to my eyes, with that little spike down. But we'll keep an eye on that. To me, the overall big sell-off comes when we hit the top of this channel. Once we've gone through the challenge of the intervention levels of 63.5, anywhere in this upper part is where I'm expecting it to finish. And then we're looking for sell-off time. That is probably when full-on intervention and full-on dollar negatives in play. So don't get carried away with the short-term pullback on UJ unless we hear a massive narrative change or the US does a July rate cut. Anybody's input? Anyone have got any other views on any of that? Right, there you go. So that's euro dollar. It's a similar setup. Obviously, we've got the backdrop of the French politics is what this is all about, isn't it? For this horrible extension to the alternation. So remember, I tried to say alternation, and it didn't look right to start with. A two wave, that was a deep zigzag in my parlance. You get a five wave move up, a consolidation, then another five. Short and sweet, but quite long. And then we said here this was twice the original time we thought that might be the end of it, and another further low. And that was bringing us over here. I've redrawn this on the basis that that very much looks like was the fourth wave. And then we've eventually put in a fifth wave low over here. So what I said the other day, we're going to have to move all this around. But what that genuinely means is that this fourth wave actually moved across to here. So you had three waves up, three waves down, and then you had a five wave to finish it. It was what they call truncation, didn't go to another high. And then we put in a final little five wave move down to put in the fifth wave we were looking for, which was over here. And now very much we're in the next wave up. We're looking for this blue wave breakout, which is probably a lot higher. We're looking for up to 110, aren't we? So we're now back into the old subwaves of all this, twos, three, and again today's little movement there, that could be a four, but we might see a little bit more negative churning over the weekend into Monday. We'll see how that comes out, but it feels like we've still got one more little move up in that. Before we get a little bit more consolidation, then we keep churning up in this whole movement up towards 110 still. That'll be over here when it happens. So in fact, I will, when I redraw this, just keep the numbers in mind for how we're probably playing out. They need to go up by a factor. But it very much feels like we're in this breakout scenario still. Everything's on track. So what can go wrong in the French elections? Obviously, Le Pen could get more, but it looks like all those extra seats have been manipulated to being the centre and Liberal alliance. We need to see what the fallout of that is. Will there be anybody that breaks ranks? And how will the country take it? So there might still be some angst, but short term, that means you saw the oats auctions. They came out very positive. People were happy to start investing again. So there is a kind of relief rally around in sort of European equities, European bonds, in the euro, but there are pitfalls ahead, and there's another vote, which I've been talking about in the European Parliament, which could get things a bit spooky. But net, we do seem to be in an uptrend now. We put in a lower low, and since then it's all high highs and high lows. So until that materially changes, it looks like we're in that pattern. Again, Saddam, I think it is your end for the muting. There is an issue for some people when they first join. You need to have a play around. So the DAX, again, we were saying that the net fallout from France was going to hold it back a little bit, and we've ended up with this end of June, early July extended consolidation. So we did get a lower low in the end since we put that in. So that looks like we had a three-wave, an expanded flat overthrow, and then a final 5 down. Why is it an expanded flat? Because we had an extreme in the middle and an extreme at the end relative to the first wave. So that makes me quite confident that is where the consolidation was. We're now into a red 3, and that is very impulsive. Since Tuesday, we've been in a very impulsive situation. So that does make me feel comfortable that we're in that. We're getting small consolidations, if anything. There's potential for 5 waves to be in that consolidation, but to me, it looks like more like we're doing a bit more extension before we put in the next bit. So we're very, at least in these waves, if not only in a third of a third. So again, the seasonality effect, the kicker from the European situation, it all sits for potential decent breakout for the DAX in the next few sessions. Keep an eye on that. So we'd originally been looking for, could we get that pullback to be in here and not necessarily take out a new low, 18,000. Like a glove. Happy with that. Again, for anyone that's not noticed, the global index performance of the year so far is the Nikkei 225, up about 20%. A lot of that has been stolen away by UJ. If you didn't cover it, there's probably a negative 16%. But net, if you covered, you've done very, very well. And you might have seen, you won't have seen it because you would have seen it on my chat, but the tweet that went out had topics on it. That's their mid-cap index, Sage of Omaha, old Buffett. He said at their AGM, their trading update, that they'd moved a lot of exposure into the mid-cap financials, which are in the topics. Some of them are in the Nikkei, looking for breadth of movement. That has happened. Now, anyone that's been following us, we had that dreamlike leading diagonal for wave 1, didn't we? And we said we want to buy that on the 3-wave pullback to this potential wave 2 low over here. And guess what? Boom. In fact, it was over there. We said we'd have 2 opportunities. You could buy here, or as we did that low net impulse overlapping leading diagonal wave 1, we said there's got to be a wave 2 to buy. So we've given you 2 great opportunities there to buy what has ended up being a lovely 5% move. And with the right stop losses involved, you shouldn't have been taken out. And here we sit now. I think we've probably either just put in a consolidation for that 4th wave, or we're halfway through it. It'd be lovely to come back to the 40,500. If not, the only thing to look out for is that a wave 4 pullback often is looking for the previous wave 4, which is back here around 40,000 again. So it's only 1% to 1 to 2% potential consolidation of the Nikkei. If the yen is having a temporary relief, that's probably enough for the exporters to sell off slightly. So you could get that, but again, still at least one more high to come for this move before it consolidates, and then we've still got further upside to come. So we'll start looking at that further upside next week, but just be careful of shorting this one because all the dynamics are still in place. Hello, Pav. Nice to see you join. So just to reiterate that, I'm not sure if that didn't come through. We've had 2 opportunities of buying this into wave 2, 3-wave pullbacks, which is how we like to buy them, rather than necessarily joining it later in the 5 waves. And if you caught the second one, I said you've had this 5% move up with very little scope for being stop lossed out. as you could have trailed that up. We've hit what could be a valid fifth wave in this pattern. We've had a little bit of two-way since, so obviously it needs another new high to show us that we're into the next stage. It's very possible, but like I said, we've got a little bit of yen movement. We might see some consolidation in the Nikkei, but it remains the main index of the year, and the fundamentals are still improving. So just be careful shorting that too much. Just looking at gold, ding-a-ling-a-ling, because I'm back to break even with my long-term position. So that's going to tease me, I'm sure. So the FTSE, just on the daily basis, again, just looks like we've been caught up in this sideways movement. Got a new low for the move, so that just means we extended across. Got the potential again that we're now in the breakout. So again, we've got there's a valid five-wave structure within that. Valid ABC for the third leg. Yeah. So you just got to see how it plays out. The FTSE, we've got through the election situation. Is there anything that the Bank of England can do in August to help out the whole strains on the economy? Again, if the Fed gets closer to going, the Bank of England will have the excuse of just staying in line to go. Our economy is a lot further behind the US. We'll get caught up in any downdraft. From there, I think as long as there's no crazy inflation print before the meeting, there's a good chance that they will go. They said it was close last time. The background looks like we could do with a little bit of emergency insurance taking. Bailey's an insurance man. He'll understand that. It's not about necessarily supporting the markets. It's making sure that if things go wrong, that they're on the right path. But dropping that down to the hourly view, let's just confirm where we are. I mean, we could validly have put in a wave one just about there, and then we're looking at a small pullback. And that's almost at where the wave four would be, generally the spot 382. So yeah, if the other indices go, that's a good one again. If you want to play it short term, have a stop loss probably down here at the 61 spot 8 or somewhere in between. Looking for, where's that? No, don't go to 61.8. Go for more or less 82.05 would sort of invalidate that. You might get a deeper correction if we go down that far. But I think this is again coming into view now that we've got all the potential UK shenanigans out of the way. We're in the global positive period. It's time for the FTSE to have a little move up again, I think. It certainly looks like this should be putting us into a wave 3 scenario. Expect an impulsive move. So that kind of shows you the issue you've got looking at the S&P. This is the S&P equal weight, and that is doing what looks like a contracting triangle, doesn't it? Why is it that we've had, what was it, 35 out of 36 all-time highs for the S&P, and yet the S&P equal weight is not moving up? That's literally because you haven't got the heavyweights having as much impact in this index. So that's the classic that it may not necessarily be negative. It's been consolidating, and I expect that should break out. That will probably be just at around the time when, as I said, when the index is coming back. The heavyweights will be pulling it back just as this is breaking out the other way. That looks like a wave 4. That's where these triangles normally appear. Yeah, so that is kind of playing out with the fundamentals we were talking about earlier, and a little bit like the question you had about Nasdaq Dow. It's all about the underlying instruments, so the S&P equal weight. As that breaks out, which is sort of positive for the overall risk sentiment, expect maybe that the overall index is coming back. Doesn't necessarily have to. The heavyweights could continue, but I would expect a small consolidation at some point. Does anybody follow oil at all? Because I keep looking at this. I know we don't have the best conditions on ACG, but I just feel like the fundamentals are a bit strange. We've got all this growth slowing down, and China again slowing down while the Americans are pumping. OPEC giving up on the price fixing, knowing they're going to have to come again. This just all goes back again to me to being a counter trend rally, and I think this will come off again. I'm going to draw oil again now because I think we're getting into an interesting short position again. Got to the mid 80s. The fundamentals with what OPEC did, the geopolitics we had in this kind of attempted breakout period here and here, should have taken it to 100, and it never did. So it's time to start looking at this. It's probably failure time again here, maximum 88. But I'm going to have a look at that. Just the usual bond market angst. The VIX, the move and the VIX. So again, bond markets have moved up on the whole Trump situation, Biden more than anything. And again, you can see we had in what again is probably the wave 4 scenario on that. It's contracting triangle that breaks out to finish. So given the data, given the chances of Biden being removed, etc., won't go away, then there's a de-risking event going on in the US bonds. It's a good point, Quang. Yeah, it is the end of a week, and I think a lot of people are going to want to spend the weekend just getting on top of everything that's happening, and will probably come into play next week. We've also not had any earnings at all really this week. Starts in earnest next week. That's when the knives are getting sharpened. The old pencils are out, get ready to go. The VIX, again, that is just back in the middle of this trading range. It's not fear or greed until it goes either way. Not necessarily telling us anything much at the minute. I mentioned silver earlier, and somebody was asking me, as Fabo asking me what remember the cup and handle? Anyone that looks at things like that, this is obviously 3-month chart, but that's only just to get in the data. Not expecting you to trade on 3 months, other than the fact it's quite important. that since we came off the gold standard, we've had these two spikes, and then the doldrums putting in the handle. Now, when the handle breaks, the trend from the top of the cup, that becomes quite important. What you tend to get then is a 6 to 12 months mega breakout, which goes the whole amplitude of the cup. So we're at the early stages of that, and obviously 3 months we've had a bit of volatility in this 3 months. But what it's telling you is, if gold and silver are about to go, silver is about to go parabolic, and this is just a conservative breakout, but it shows you that it could very easily go, if not two or three times higher on the silver side. The gold has some big upside, but in the short term, that's where your money can be made. Pav, cocoa. Cocoa's there's going to be a quiz question for tomorrow. Like, what is the most outperforming asset of the year? It's cocoa, isn't it? But it's coming back. But all about the weather patterns. Now, there's been a lot of futures buying by the hedges, but the hedges have taken tons of stuff off over June in everything. So the Fabo again put a chart on from some research on my chat yesterday, which is just showing you it was across all different things: commodities, energies, metals, base and precious, etc., etc. And they say the hedges are in the Hamptons is the phrase at the moment. They just took risk off in June, said it's all just getting too noisy. Don't want exposures either way. So to a certain extent, some of the puff may have come out of cocoa. We don't trade it. I think that's about the only thing that's not on our alpha futures, which is a shame. But yeah, the rainfall, there was drought, and then the rainfall came back. The rainfall came back so much in some areas that it was going to actually wipe out the crop. So, and there is potentially a big shortage, and it is what they call inelastic demand for cocoa, just because the chocolate makers will pay any price for it. Heck, Soren, I'd like to say heck. There is a trend here. I don't know what it is, but anyone that's kind of new to this, at your end on YouTube, you need to play around, because we feed into YouTube from another instrument, and a lot of people who've been here regularly have got themselves adjusted, and they seem to be okay. So there is an issue. I don't know what it is, but you've just got to play around with some settings. But I couldn't be louder on anything that I'm recording on in this setup. On max. So this was New York advances declines, and there was some chatter about how the S&P particularly was trading opposite to this, and it was starting to cause issues. But you never know. We might be about to return, because if we look at where's the S&P? The S&P. We're just beginning to bounce off the bottom of the stocks trading above 200-day moving average. They've been low. We've just started to increase a bit there. We've just come off the short-term bottom we put in for stocks above the 50-day moving average. They're getting back to zero. So going into earnings season, look out for the stock performance. We need, for the rally to really come back, we need to see a little spike up in this. Just be aware that all this declining volume at the highs is getting a little bit better again. Amongst that, we're missing the share buybacks. A lot of these stocks go on to lockdown basically until they've updated, then they can come back and start buying their shares, but they can't do it when they're in what is called a close period. The company knows more than the market, so you're not allowed to be buying the shares. So they will come back to give us another boost as we get through earnings season. We kind of, not everyone's on the same date. It's obviously a rolling thing. So it's about looking at the stocks that have got big announcements like Apple, etc., and working out when they update and seeing how that is potentially going to affect the flows. So it's important when you go through earnings season that you are aware of the dates of when stocks are coming out that affect the index materially. And then also if you can find out and have a look at the extra special things, the buybacks, that's where they're a buyer of their own shares. Those stocks tend to outperform in the periods when that's happening. So again, we're just working out where this 3 and 4 is going to be. We keep extending on lower breadth and lower volume. It's all the signs of we're getting close to a short-term high in the S&P. That's with, again, just be very careful. I'm bullish overall. 3-4 means you have to have a 5, but we are, even how I'm looking for it, very close to this being done. And this is an extended 1/5 of a 1/5 of that 3 wave. So we're very, very close to that coming to an end. Nasdaq again. Within that looks like a 1 and a consolidation, 3 consolidation, 4. So that needs to extend as well. On the daily, and that is classic as well. We've had the MACD high for the move is where we've just moved that to being a 3 wave. So this is a classic that you're going to have a pullback, and then what we got there? There's a 3 gone. Anyway, the 3 should be there. You get the third wave is normally where you get the MACD peak, and it's in deep positive territory there. You get a pullback for 4. We'd expect to have a higher peak there for 5th wave. So then you got a high with a lower MACD. That's divergence. That's when we'd expect to see a little bit of pullback. This is where, with the heavyweights and that whole thing I've just been talking about, with the S&P equal weight, this 4th wave consolidation up here, when it comes, it's at a high degree. So you expect it to be a biggie. It's got potential to be a 10%er because the previous degree lower down 4th wave starts over here around 18,400. So once we do put this in, we do need to be careful. We've talked about that being a consolidation before we go again. The overall period from June to August is normally positive. So that again suggests that the pullback in June started here at 18,500. So if we're expecting the whole move to be positive, 5 to 7% on average, isn't it? From there, so that is 1,000 points. So 19.5 might be an ending point over here for that, just to be in line with history for the kind of end of August. So we're looking like we're going to be going into a choppy period. We'll deal with it as to how the heavyweights report as to whether this could be a shallower pullback. But S&P and Nasdaq are very much on fumes. Just be very, very careful as we go into, I think, remember, where's that gets to? Monday the 15th of July, that is the end period for the outperformance. It all sits well with us being, this one more push. But don't fall in love. We are overdue some consolidation. And the Dow one, that is a bit messy, and it is all a bit sideways, and I'm looking at this, and it needs redrawing to take account of that, which again, at best, is we're either still working out some form of triangulation here at the end of a consolidation, which means it could be a wave 2. The whole thing can't be a triangle, which doesn't look like it is. That's telling you it's more like an early part of the move. So we may not have even gone beyond the second wave yet, in that it's all very messy. Hasn't taken out a new higher high over here. It's all to do with the components of the index. It's telling you that, as we've seen from the S&P equal weights, the rest of the index isn't moving. So the Dow ones, which particularly need the prices to be moving to have an effect rather than the market cap, is going sideways. So it's not the leading index in this move at the moment. But if that is a triangle in that position, it's building for some form of breakout. I will redraw that one for Monday. Have we got any questions for anyone that can hear me? So I don't know if any, obviously I've been talking here, not really watching any headlines. Has anybody come out and said anything that I haven't covered or opposite to what I've said? Are there any talking heads? The Dow is a bit flat, isn't it? The Nasdaq's up. So Nasdaq is driven by interest rates. It's a bit of a bond proxy. It's long-term discounted earnings in the main. Don't get many dividends in the Nasdaq. That's annoying, Pav. Gold at the moment is holding in my zone, and that'll hold exactly there until we get past 430. But this, like I said earlier, be careful now because we could be in the proper breakout zone. Will it have a look at 24? We haven't been there for a while. Hi, Quang. Because we don't really look at them. I don't really cover Bitcoin particularly at the minute. Everyone's got bluffed in on Raoul Powell's banana trade. If liquidity is about to increase with interest rate cuts, etc., and you've got the things like gold moving up, then you'd like to think that Bitcoin is bottoming out, surely. But it's been a painful move that anyone that got bluffed in on following halving and ETF flows, and there's some hefty offside positions, aren't there? But it's trading. I'll put together a chart for Monday. I don't normally look at it, but I'll do something for you. Pav, what you're saying? Planty, am I thinking, would we ever do a mic chat room sometime for market preview and questions? What do you mean by that? Yeah, it's just easy for me to control if you're typing. We'd have to have an experiment, just how to make sure we've only got certain people asking. Yeah, no, if that's something that you want, we'll certainly look into doing it. I know that previously people wanted me to set up like this because you have situations where it either gets dominated or people can take over with the vocals, etc. But no, we'll certainly have a look at that. Are there any other market things to look at? Otherwise, I'll wrap it up there. Hopefully there's some food for thought for everybody, just like you said, Pav. One of my favorite UB40 songs, if anyone follows the old soft reggae. So like I say, just be careful. We've got some short-term positives that will end up being support. I am an old dinosaur. You're definitely right there. And but just be careful. A lot of these things can sometimes turn into travel and arrived until it sorts itself out. The indices should go better, but we might just have to play that. So it might be a case of looking for shorts around the top of that channel that I've got in, just to play along for It's a very big hurdle rate, as we talked about at the start. 9% earnings rate for the S&P for Q2 is tough. Thanks for coming, Pav. Yeah, good input as always. Have a good weekend. So yeah, just we potentially in breakout for the interest rate sensitive instruments, dollar sensitives, but let's say indices potentially got a little bit of sideways in them as well. So it is tough. It's going to be a tough environment, but I'm sure you guys are going to be all over it. So good luck, and please join me on my chat for any follow-up questions. Brilliant. If not, have a good weekend.